How's it going, everyone? Welcome back. It's a Friday here. It's raining, but at least the haze from the Canadian forest fires is going away. So trying to staying positive. Yeah, at least I had Friday off, which is good. So I hope you're all doing well out there. So this video, I'm going to go over an investing approach that might be beneficial to you. I don't know. I would have liked to have known about this. This might have been when I was 20 or so. So you might find it useful. So it's, as the thumbnail you already saw, it's a core satellite investment approach to your investments. So getting into it, the benefits of this is it brings some stability. It brings stability to your investment portfolio and also gives you not such a reliance on picking winners. Like, so a lot of dividend investors think, because all the dividend investing channels you'll see, they pick individual stocks almost exclusively. And that's how I started, because I didn't even know ETFs existed, which I've talked about this. I've already beat that over the head. But you people out there know that ETFs exist now, and you know about mutual funds and individual stocks. And to be a dividend growth investor, you don't have to pick 100% individual stocks in your portfolio. So you can still be a dividend investor and have ETFs and have more stability, especially if you have a 9 to 5 job like I do. So you don't have time to follow 40 companies. Maybe when you get to retirement, you could actually, fill out an entire dividend portfolio, because then you could just manage it all day for a living as a hobby. But while you're working, so this approach would allow you to still have a core stable investment that tracks the market and also gives you some allowance for some more active investments, so you can learn how finance works and also just stay interested, right? Which you should have some sort of finance competency in life. I think it benefits you in general. So this could allow you that. So we'll get into it. Now, I don't know your situation. I don't know if you have access to 401ks and all this type of stuff. I'm giving you this approach from a dividend growth investment standpoint. So when I talk about certain ETFs, you're going to be like, well, why didn't you talk about this one or that one? I'm giving a specific perspective on this. A growth investor could still look at this investment style, and they could generate a different allocation, maintaining the same approach. So they talk about market timing and security selection provide short-term gains at times. However, the long-term studies have shown that it's really hard to beat the market. And I've shown research in previous videos. You can go back and look at the Hartford studies I showed. The markets go up over time, so you want to capture the broadly diversified market appreciating, especially in the U.S. So if you pick all individual stocks, then you're going to miss out on some of that gain, because the years that you don't, the stocks that go crazy, right? Like this year, we've only had a handful of stocks that have really done well in America. It's only like maybe less than 10. So if you didn't have investments, or if you didn't have some sort of ETF that had an allocation of those, you didn't get any of that benefit. So this approach gives you flexibility while it still allows you to benefit from the long-term appreciation of the markets. So here's the core of it. So there's an index core. Now, your core could be individual stocks, which technically my core for the longest time, as I've said, I have 5 core holdings. Technically, that's my core for now. As I transition to ETFs, so I am changing it, but that's my journey, because as I've talked about. So your core investments in this approach. So you're just seeking a market return. So it doesn't. I'll get into some examples, and I'm a dividend examples of what the core could look like later. So you're trying to minimize costs, minimizing risk. You're minimizing volatility. This is a long-term focused ETF or mutual fund approach, the core. You're just dollar cost averaging into that the rest of your life, basically. You're minimizing taxes by doing that. Now the satellites, so then the outside perspective, you're trying to find alpha, let's call it. You're trying to find investments that outperform the market. I would say like you're trying to find um, investments that outperform your core is the way I would look at it. So whatever your core is, if you're going to take on some sort of active approach investment, you're doing it because you think it's going to outperform your core investment. Otherwise, why would you do it? But you're going to take on higher costs. It's a more short-term focus. So this is where you would have room to speculate or, short-term, or maybe it's a 2-year thesis on an investment, but this is not like as long a term approach as index core, and so forth. So this is a very flexible strategy. So as it says, you want a broadly diversified index core, and it's tax efficient because you're not buying and selling it, obviously. Now this is more about like your Roth and like if you had a personal brokerage account. Can you do this in a 401k? I mean, if you had an actively managed 401k, I guess. I mean, if you're like me, you just do the best you can with a 401k because you only have like a handful of choices. You just get a broadly diversified 401k portfolio, minimize your fees, and let it just do its thing. So they're talking about this reduces the core, the advantages of the core being a broadly diversified index. You're minimizing active managers that could like screw up basically. Kathy would, but so and it's a broadly diversified portfolio, so you're getting the appreciation of the whole market with something like this. Long-term performance, we know like the markets appreciate on average 7%. They don't actually appreciate 7%. It's usually like 18 and then 2. So I don't think it's ever actually done 7% that I've seen. It's all about so this is talking about just the core, like long periods of time beating the markets actively. I think you're all aware, like the vast majority of active managers, I think it's over 80%, don't outperform the markets. So they find some other way to get fees. I don't know, sales or whatever. Kathy would. So again, it's just talking about it's more tax efficient in the core to have a broadly diversified index. My like I said, my core it's just the way my investing developed. It's like long term. I've held them long term. So you're talking like McDonald's, Lockheed Martin stuff. I've held these for a very long time. So they are tax efficient. But like I said, I'm in transition to something similar to this. I like this approach. So you can see this still talking about the benefits of the core. So you can get this report yourself. It's from Vanguard. This isn't a secret. So there's no, it's not the one thing, like, it's not like a step 1, 2, 3 approach to investing. There's flexibility in how you, based on your risk profile and how long, the most important thing is how long you have until retirement to do this strategy. If you're 10 years out from retirement compared to someone that's 30, 40 years, you'll have different investments, but you'll still maintain just the idea of the core and the satellite positions in your portfolio in general. So this is just talking about like some of the benefits of this approach. So anyways, so like we said, core funds, as the name suggests, it's the heart of your investment portfolio. It's the main building block around which you construct your satellites. Your core should be solid performing investments that deliver regardless of market conditions, low volatility. These are passive uh, options. So, obviously the one you're going to SPY. Okay. That's the most obvious core position that you could have. You could have individual stocks. I don't know if I would recommend it, honestly, but like say, okay, SPY, and maybe you really like Amazon. You think Amazon's going to take over the world. Okay. So maybe your core is SPY and Amazon. I don't know. It's up to you. So satellite funds, like we've said, are actively managed, more volatile, riskier, but they can generate a higher return for you. And it's a way for you to express your own. Now, the thing that the satellite fund positions will allow you to express your own interests or your own investment uh, ideas in your portfolio. So are you, if you're maybe you're a macro guy or a dividend growth guy like me, or you're a growth investor, so you have your core of an index, but now you can express your own personal beliefs in investing in your satellite position, which I'll show. So you could have like the entire US market, and then your satellite funds can represent your interest in growth investments. So this is, which is good. It helps to personalize the experience, and I think it makes you more involved in your investment journey, because you're going to be you're more interested in this than just to buy one specific ETF that you don't really care for and you find it boring. I don't know how long you're going to last. Are you going to consistently DCA into something you don't like? You need to find an approach that's, that works for you, but it's also based on research and it makes sense over long term. And this kind of mitigates some of the damage an actively managed portfolio could do to you. It still lets you do some of that, but it also mitigates some of the risk, and and it won't wipe you out completely. So this is just my example. Okay, don't shoot me over this. So I mostly wanted to show like dividend type ETFs. I mean, okay, core. I'll say right now. Obviously, you could have VOO or SPY. Okay, we got that. So everyone knows about that. We're going to move on. So you have like core positions, to me, broadly diversified funds. So these are broadly diversified and they're low. Most of these are pretty low fee. So DGRO, I'm going to do a video on that coming soon. That's next. Talking about DGRO. And then we also got this is the dividend growth fund for from Wisdom Tree. It pays monthly, a little higher fee, but again, it's broadly diversified fund. And then this is the large cap version of Wisdom Trees. And then we've got Vanguard's versions of dividend appreciation and dividend high dividend yield. I just threw these in there because maybe people don't know about these. So this SCHK is the US market from Schwab, the whole US market. And SCHM is the mid cap version, so like the Russell 2000 version of Schwab. So we'll give you something new you've never, because everyone talks about Vanguard all the time. So those are really good investment options. To me, like satellite, so I'm thinking it's not necessarily active. Some of these aren't active, as in someone's picking stocks, but these are, smaller ETFs. They're not broadly diversified. They're specific. They have specific objectives, some of these. So this is a State Street dividend, or like high yield dividend fund. Then there's HDV. These two are monthly payers from Invesco. This one's low volatility, and this one is, I think, S&P 500 Noble Fund. So these are like very specific. Some of these only have 50 or 100 holdings. They have a specific like active objective rather than just tracking a broadly held index. So they might pick from an index, they might select stocks for a specific objective for you. And those would be satellite positions in my mind. And I put moat there as a joke, but whatever. So these are all smaller. They hold 50 to 100 stocks. But if you were a dividend investor, it would allow you to express that you're a dividend investor while still holding a core. So you could hold like the entire US market. The satellite position allows you to express your desire to be in dividends. So someone could say, well, why don't you just buy the whole US market and don't do this silliness? And go right ahead. I'm not going to debate you. If you can find an investment process that you dollar cost average into and you don't bat an eye when things go bad in the markets, then you have won in life. You're doing great. So this is all about finding a process that you can stick to for the rest of your life. And that's what I hope you can learn from this, because a lot of these, like right now, we're dealing with lots of recession doom and gloomers online. And, if you sold out of the markets because you were afraid of recessions and the US debt ceiling, you just missed out on a 700-point day in the markets that just happened about a week ago. So your doom and gloom cost you one of those days. And I've talked about it in another video. You miss out on like 20 of those days over a decade, and they have a massive impact on your returns as an investor when you miss out on those 700-800 point days in the market. Huge impact on your performance. And you never know when they come. I don't think anyone, did anyone know that that was going to happen? What was it last week? The 700 points. So that's the point. Now here, okay, this is just an example of like what, what could this look like in real life? I'm not telling you to do this. So keep an open mind, people. I hate when people don't get that point. Like, this is just an example. I'm not telling you what to do. But so like in this situation, let's say DGRO, it's a dividend growth ETF, but it's broadly diversified. It's got over 400 holdings. It's a broadly diversified, low cost ETF. So it fits the criteria of a core investment. And then to me, SCHD, in my mind, SCHD is a satellite position. Some other people could interpret SCHD as a core. To me, it's not diversified enough. I don't agree with that. And there's a stock picking selection criteria to it that I put it more in. It's not active, but it's more like an active ETF. So let's say, so in my idea, core and satellite, the percentages, obviously everyone, there's no set percentages, but by and large, from what I've seen, your core should be 50-ish percent. So think 40 to 60% of your total holdings should be the core. So I just cut it down the middle. 50% DGRO. And then your satellite positions, to me, you'd probably want 25%, let's say the other half, or the quarter of your holdings would be some sort of actively managed ETFs that fit your personality or you think could outperform. So like Moat, I'd make jokes about it, but so Moat would fit the criteria of a satellite because it is actively managed, higher fees, but you are taking on the possibility of outperforming the market. So it becomes a satellite holding. So that could be something you could put in this instead of SCHD, it would be Moat or SCHG, which can outperform the markets. If growth continues to outperform, SCHG could be a good satellite holding on top of something else. So this allows you to express yourself while also not going crazy, basically. You're not required to pick every investment in your portfolio because it's hard to find time to pick everything if you're working. This allows you to express yourself, but at the same time, protect yourself from yourself, if you know what I mean. So in this example, let's just say, okay, I'm like 50% core, 25% some sort of more active ETF, and then say I commit 25% to actively picking individual stocks. So in this thing, say I feel tractor companies are going to just go crazy with the agricultural revolution because of drones and robots, whatever, something like that. So I buy John Deere Agco and something else. So, and then maybe I think the Becky index is just legit. I think Starbucks is going to kill China and they're going to just dominate the world. So I think it'll outperform. So, okay. So in this example, I've made some tactical individual investments that pay dividends. And then 3%, maybe I have some, some bonds. So this fits this is like what a core satellite positioning could look like for you. Now, like let's say my tractor thesis is garbage, all right, and this gets like cut in half, and I'm a clown. Okay, I didn't get wiped out. My investment journey is still intact, so it's only affected 10% of my portfolio. I still have my core investments that are intact that I keep DCAing into. So I've protected myself, but I've still played a little bit to try and outperform a bit. So this is I like this approach in theory for a lot of people. And in the comments, you don't have to be like, well, it's so Drogo. What about this? I'm giving you examples. It's more important that you understand the idea of a satellite core positioning than anything. So we'll get into Drogo, and so you would say, why would I take Drogo over SPY? Which Drogo DGRO will be my next. That's my first ETF. Over a review because I think it's fantastic for a dividend growth investor. I think it should be the core. I love it. I think it's really solid, and I'll get into it in another video. But it fits the thesis of a dividend growth investor. So here's SPY. So the market, so you're getting for the S&P 500, you're getting about a 1.5, and this fluctuates over long periods of time. SPY has returned various forms of yield. It's actually on the lower side the last 10 years than it has been historically. But right now you're getting about 1.5% dividend yield, and it's only growing 5.5 to 5.9 per year. So if you have DGRO, you're getting almost the same size. It's like almost 500 holdings. It's like 4 or something. You're getting 0.9% better yield per year up front, and then you're getting double the growth rate than SPY's returning. So I can show in another video just the compounding. This is the essence of dividend growth investing. You are seeking investments that have long-term growth potential and have outperformance in dividend growth than other investments. And then that compounding over your life, 10, 20, 30 years, will really just kick in, and just you'll have a great return, and it should be good for retirement. I can show like a dividend yield calculator on another video, but so that's kind of the idea of this. So if anyone has any questions, you can put in the comments. 20 minutes. I try and keep my videos to 20 minutes. I don't think people really want to hear me babble for longer than that. I mean, if you do, let me know. I can do longer videos, but I'm going to try to stick to like 20-ish minutes for videos. But I think it's an interesting approach. And I would say the pie is like all your investments. I'm thinking like your 401k, your Roth, and a personal brokerage. All of that combined is like this approach. But you can think of it in different ways. Like I said, I have different approaches in all my investments. I mean, you can't really do a dividend process in your 401k. So it kind of is pointless to talk about it for that. So just something you can think about. I think there's some other YouTubers have covered this process. So there's other YouTubers that have covered this. You can find their videos. I didn't find a lot of research on this topic that I thought was that useful for you. If I do, I'll put it in the comments. So if you find this interesting, maybe you can give it a shot, or do what you want with it. All right. So everyone have a good day. I will see you later.
Thank you for your cooperation. Good night.